Hello and welcome to BST Live. Glad you could join us today, where we're going to be talking about how to detect when a strategy is failing. So let's get to it. Well, hello, good morning, good afternoon, good evening. Welcome to BST Live. We've got a great topic and guest here today. So glad you could join us. I can see there's some new people in the chat. So, hey, Mark. Hey, Adam. Thanks for coming along. And also thanks to the regulars as well for joining. If you've got any questions or comments, please post them in the chat. And let's get to the show today. So, as I mentioned at the start, we're going to be talking about how to detect when a strategy is failing, which is obviously an important thing for all traders, especially algorithmic traders. And the guest today is a fantastic guest. I can't wait to speak to him. He's Kevin Davey from KJ Trading Systems. No doubt you've heard all about Kevin. He's been trading for over 25 years actually, so he's got a good history. He is a World Cup trading champion winner. I think he placed in the top two, maybe three times, and he even won it. I think it was in 2006. He's very well equipped to be talking to us today, and he's got an interesting background which he's going to share as well. So, welcome, Kevin. Great for you. I'm really glad that you could join us today. Thanks for coming.
Hey, thanks, Andrew. It's a pleasure talking to you. It seems like it was years ago that you and I were hanging out in Times Square in New York during a trading conference, but it's
Yeah.
always good to talk to you.
Yeah. That was quite a while ago, actually, wasn't it? So, how are things going in the States? I know, we've got some troubling times at the moment, and with the COVID pandemic, and not to mention all the social unrest and the US elections coming up. So, how are you coping? You doing all right over there?
Yeah, just trying to trade, as normal. This year's been kind of a crazy year for trading. It
Yeah.
Just with all the COVID stuff, and now it's kind of picking up again, and hopefully the whole country doesn't shut down. But
Mm.
I guess we'll have to see.
Yeah. So, that obviously has some implications to trading and to strategies. And I think it's really timely to the topic that we've chosen to talk about today, because, there could be traders who are going through strategy failure now, or perhaps it's coming because maybe the markets are changing. So, and I know you've got some really cool techniques to share with us. So, first of all, though, I wanted to ask about, I know that you've got a background in manufacturing and engineering, and that kind of guides a lot of the work that you do in trading. So, can you tell us a little bit more about that and how that has, I guess, instructed the way you look at strategy failure today?
Okay, sure. In my previous life, so this is probably going back about 15 years or so, I was in charge of quality, and then I was also in charge of engineering and quality for an aerospace company that made fuel pumps. So these were for jet aircraft. So basically,
Mm.
if you've flown just about anywhere on a jet plane, you probably had our product on it, and it was a product that if it failed, the engine would stop. So it's kind of like the heart
Oh, goodness.
of the engine. So it was, yeah. So it was a pretty safety critical type thing, and we had our manufacturing facilities here in Ohio, and we would make all our product, and we would actually reject parts sometimes for 1/10,000th of an inch. And just to give
Wow.
people an idea of what we're talking about, take a normal sheet of paper and slice it up 30 times. So the thickness, cut it into 30 sheets of paper. They'd be like
Wow.
razor thin. And if we had a part that was out by one of those 30 sheets, a lot of times we'd throw it away. We'd scrap the part. So
Goodness.
needless to say, we had to have machinery that was pretty high tech and that could work with close tolerances. And we had to keep those machines in control. Okay. And it had to produce consistently good parts all the time.
Yeah.
And so what we used was something called statistical process control. And you have a chart that you can show, if
Yeah,
you could
sure do.
show,
Yep.
um, that kind of gives people an idea. What this is every part you make, you measure it, and it will tell you if you're in control or out of control. And there's certain rules for this type of analysis that says, hey, if you make too many parts that are close to the high limit, the high dimension, then you got to take some action. And if it's too
Mm,
much to the low dimension, you have to take some other action. So what it does, it helps you to keep your process in control. And so we use that in aerospace, and it saved us a ton of money because it helped us to make good parts. So what I did when I started trading, especially when I went full time, I said, wow, it'd be nice to take that type of concept, proven concept of statistical process control, and put it into trading.
mm,
And where I decided to put it into was in some of the Monte Carlo analysis and simulation to help determine, for example, when a strategy might have to be retired. It could tell you when the strategy kind of went out of control. And
mm.
that's kind of what I use it for.
Yeah, yeah. Okay, well, I know we're going to talk about Monte Carlo simulation a little bit more, but first I want to talk about, I guess, one of the traditional techniques that I think a lot of traders use. I even use this myself in my earlier days, and that is just to look at the drawdown figure on a backtest report. Okay, so you've got a strategy, you run it through the backtesting process, it spits out a number at the bottom saying open or close drawdown $15,000. And they take that and they say, okay, well, if it gets to that level, or maybe 1.5, or double, or even half, that's where I'm going to say the strategy's failed. Do you think that's a good technique? There are benefits or disadvantages to looking at it that way?
No, that's certainly one way to look at it. And if you don't want to go through this more complicated analysis, I think it's a valid technique. So I still use it on some systems myself
Mm,
because it helps you. Uh, it almost tells you when things are out of control. Because if you ever get to a new worst case drawdown, that's probably a good time to at least consider stopping. And like you
mm,
said, I know people who use twice the amount of drawdown, sometimes half. Uh, a lot of it becomes a personal choice. I think that the biggest thing with all this of when to stop a strategy, what it really comes down to is maybe not even necessarily the exact method you use, but it's to have a method. And I think
okay.
where a lot of people get messed up is they don't have a plan until it's too late. So, meaning the time to come up with this, whatever you're going to use, it could be drawdown, it could be the statistical process control we're going to talk about, it could be the number of consecutive losing trades being out of norm, could be
Yep.
losing months. There's a lot of different ways to do it,
Yeah.
but I think what the key is to write down what you're going to do. First analyze it and say, okay, this makes sense. If in the whole history of my testing, let's say I never had more than 5 losers in a row. Now all of a sudden I have 7. Maybe the strategy's broken. So you determine it first. You kind of analyze it, and then you write it down and say, hey, if this happens, I'm quitting.
Mm,
I'm just going to turn the strategy off. And that's where most people get messed up, is they don't come up with this beforehand. And
yeah.
what they try to do is in the middle of a bad drawdown or whatever, then they panic and make a bad decision. So
Yeah.
you make the decision beforehand and then you just live by it. And, it doesn't make it easier all the time because it's always hard to turn off a strategy, but uh, that's probably the best way to go, is to have that done up front.
Yeah, yeah, that's a good point. And I do want to come back and talk to you about metrics in a little while, but I think first it might flow better if we talk about Monte Carlo simulation, because you've already mentioned that. So before we get
Okay.
into the details about that, can you just give us a bit of a quick background on what is Monte Carlo simulation and why is it needed by traders?
Okay. Sure. Uh, you know, with trading, well, let me back up a little bit. With any kind of analysis of a random event, let's just take a coin flip, for example. you can have all kinds of different paths based on the heads and tails of a coin, right?
Mm.
Now, with a coin, a normal coin flip, 50% heads, 50% tails, you can actually theoretically calculate odds of, getting wiped out and that type of thing. But in trading, you don't know those percentages exactly. And so you can't really figure that out. So, what Monte Carlo simulation does is it helps determine probabilities of certain events happening. So, say, for example, you have a trading system and you start with $10,000. What are the chances that after 100 trades you're going to make money? Or what's the chance that you could get wiped out, if your equity goes low enough? So, Monte Carlo analysis helps with that. And it's a pretty well established technique that's out there. It was actually used way back when in the 30s and 40s when they were looking to build nuclear weapons. They didn't have the, I guess, the processing power to actually figure out these equations exactly. So they'd
Mm.
use this random number type simulation to help simulate, nuclear explosions. So it has some good theoretical basis, and it turns out for trading systems it works pretty good, and it helps you get some of the probabilities, and because that's what it's all about.
Yeah.
You can look at an equity curve, for example, and that just tells you what happened, but it could have happened in 1,000 different ways.
Mm.
So that's what Monte Carlo analysis helps you do.
Right. Okay. And I think we've got some slides to demonstrate that. But so basically, what you're saying is that that drawdown number in a backtest report is one possible scenario out of many, right? And with Monte Carlo, you're actually looking at, well, what are the other possible scenarios and how could they impact what we're doing?
Right, right. I mean, the problem with an equity curve, and maybe you could just show uh, the one slide of just the equity curve by itself.
Yeah, sure.
Uh, you know
Um,
that
the first one, you mean? This one?
right there, yeah.
Yep.
So that shows you, that's just an example equity curve, and that's historically what happened. But if you were just to take those trades that are involved in creating that equity curve and just mix up the order, just put all the trade, plus $100, minus $200, put them all, write them on a piece of paper, each one, and throw it in a hat and just pick them randomly. Depending how you pick them, you could get all kinds of different equity curves. And uh, I think you have a chart of that, of just the
Yeah. This one?
right there.
Yeah.
So all those paths are based on the same data, but that's what your equity curve could have looked like if
Mm.
the trades had just come out in a different order. And what's nice about running this Monte Carlo is then you get an idea of, well, hey, look at that bottom curve. You can see it goes down. There's a couple that go down and then go flat because you ran out of money. You
Mm.
were ruined. Well, if I'm trading a system, I'd want to know, well, what are my chances of that happening? If
Yeah.
it's 1% or so, it might not be bad, but maybe it's 10 or 20%, and then you might not want to trade it. So the Monte Carlo really helps you in determining where you are with this trading system and how good it actually is. Just
Mm.
looking at the equity curve, it's not enough. You need more than just that to see what's going on.
Yeah. I think that um, just looking at this slide here and have it formatted like that, you could theoretically you could have done a back test that produced the lowest or the poorest quality equity curve there, or by chance you could have got the one that produced the best. And it's the same strategy in the end, right? It's some variables involved there, but to think about to think about it like that really does open your eyes into what is this strategy actually doing, and how do we really understand the true performance in with that strategy.
Right, right. And then
Yep.
if you go on to the next slide, it also helps guide you into what could be happening in the future. If you assume that this strategy, the trades that make up the strategy are just going to kind of continue in some kind of random order in the future, you could get all these equity curves. And if you notice with this particular system, which isn't a particularly good one, but that's kind of why I used it as an example, there's a lot of times where you lose money. So, a lot of people take for granted that if the equity curve's going up and to the right, that they're going to make money. And a lot of people get trapped by this, where maybe after a week or 2 weeks, hey, I haven't made money, I'm going to throw away this system. And then they move on to something else, and they're constantly jumping from one to another.
Yeah.
Where if you do this analysis, you can easily see that, hey, there's probably a chance that you're going to be losing money even after a couple weeks or a couple months. It depends how you analyze it, but it's no guarantee you're going to have success right off the bat.
Yeah.
And that's what kind of makes this powerful. It gives you a range of, hey, you could do this good. On average, you'll probably do this good. But what a lot of people look at, and what I think is good to look at, is to look towards the worst case, because that's really what you want to protect yourself against. Well, how bad could this be?
Yeah.
And, you go from there with the analysis.
Yeah, absolutely. I just want to apologize as well, Kevin, that I've cut your face off the camera angle there.
Oh,
that's my mistake, but I think that side of your face is the best looking side anyway, so people are getting there. But so that was a really good example. Thanks for sharing that visual. Now, a lot of the things you said were benefits. Are there any drawbacks to using this tool? Because I think a lot of the tools we use in trading can be abused, right? You can maybe misapply it or overuse it, and it can get you in trouble. So what about Monte Carlo simulations or Monte Carlo analysis? Is that
yeah,
there's
definitely drawbacks to it.
Yeah.
The biggest one, it assumes that the trades you had in the past are going to be the trades you have in the future. So let's just say you developed your system incorrectly, or you're using in-sample data, not walk forward or out of sample data for your analysis.
Yeah.
Then your results are going to be skewed, could be a lot to the upside. Let's just say they were really over-optimized or curve fit. Then Monte Carlo analysis, it's going to be that garbage in, garbage out. You give it bad results to start with, it's going to end up being bad. So that's the biggest disadvantage, is if you built your system wrong, it's not going to help. The second one probably is that the market could change. So for example, let's just say you built your data on the last 4 years of US stock market, where Trump's the president, and let's say in 2 weeks now we have a change in president, and maybe it won't be appropriate to use that same data anymore, because now the market might have some kind of fundamental shift. So that could be a drawback too. So you have to make sure that what you're applying it to actually makes sense, as far as the market didn't change. And then a third one too is any kind of back test, whether you're looking at out of sample data or walk forward data, which is what I use, is always going to be a little bit, hopefully only a little bit, optimistic. Because if you think about it, you've tested a bunch of trading systems, and this was the one that you determined was worth trading. So it's probably the best. And that means it probably had some luck in it, some good luck. There's always, maybe maybe it's 90% your trading edge is what's driving your results, but maybe 10% is good luck. And in the future, hey, good luck usually becomes bad luck, or good luck becomes no luck. You know what I mean? So your back test is probably not going to perform to the same extent. So you could still use it. You just have to be careful about, especially to the upside, being over optimistic. And that's why for some of the things I use it for, it actually helps a little bit because when the performance goes down, the you know it exits a little sooner than it would have because now it's accounting for that luck factor. So those are some of the reasons. There's other
Mm.
things too with Monte Carlo. For example, if your strategy results are what we call serially correlated,
Yep.
where if the result today depends on your trade yesterday or the day before, then you have serial correlation and you can't really use this Monte Carlo exactly this way. You have to do some different things. So that could be another issue. But a lot of
Mm.
trading systems I see that there is no serial correlation. So it turns out practically it's not a huge issue, at least from what I've seen.
Yeah, yeah. I actually, as you were mentioning that serial correlation, I was thinking about an article I saw on the internet many years ago, and I don't even remember where I saw it, but they were talking about the impact of serial correlation on Monte Carlo, and I I think I remember the implication was that it didn't really work so well for particular styles of trading, like perhaps trend following. You might get a series of wins in a row, and then it'll stop performing for a while because it's typically got a lower win rate. So, do you think Monte Carlo analysis applies better to specific styles of trading or styles of strategy?
Um, I haven't really noticed that. I mean, so I've used it both trend following, mean reversion.
Mm,
It's seemed to work pretty well. And I've also used it actually when I've had systems that I knew had serial correlation. And I found even in those cases that it still was useful.
mm.
So eh, I guess from my perspective, uh, I know from a theoretical point of view, people would say, "Oh my gosh, you can't use Monte Carlo for that." But
Mm.
from a working man's perspective, it seems to be okay to use it on just about every kind of system.
Yeah, yeah. I just noticed an interesting comment in the chat actually that let me just put it up on the screen here from Tim. It should come up. There we go. My models tend to be in form or not. So I assume that means they have a good period and then a bad period. Thus, Monte Carlo is not really how life works for them. So I guess that kind of goes into a little bit about what you were just saying there about it tends to work for all different styles. So can you give a little bit of more feedback on what Tim might be suggesting here?
Um, yeah, let's see. So he's, I guess I'd actually have to run it with his results to see because it sounds
Mm,
like he's saying, hey, he gets a lot of losers in a row
yeah.
and then maybe a few winning trades. And as long as it's not necessarily a serial correlation thing, you could just have a system that does that and isn't uh, or doesn't have serial correlation. You could just have a trend following system, for example, that only wins 20% of the time.
Yeah.
And so you'd get exactly what he's saying, where you'd get these long runs of losses. So without
Mm.
knowing more, it's kind of hard to say exactly what he's seeing.
Yeah, yeah. Okay. Thanks, Kevin. We've got quite a few more questions in the chat, but I'm going to save them for later because I know we've got some other cool stuff to talk about. So Monte Carlo analysis, how do people get started if they want to start exploring these techniques? Can you offer some insights or some tips on traders who want to investigate this technique more?
Sure. Probably the first thing, since we're just kind of giving an overview today,
Mm,
if you go to my website, there's an article. If you go to the article section, there's an article it's called Monte Carlo Analysis and Probability Cones. So where it kind of talks about a lot about what we're talking about here
mm,
in more detail. So that would probably be the first part. And then part of that is I actually have a spreadsheet there. It's in Excel format, uh, which you could download, and it would actually run the Monte Carlo analysis and actually do all the analysis that we're talking about. So you don't necessarily have to be an expert to know how to do this. You just have to
Yeah.
know how to use the tool, and that's probably where I where most people can safely stay. Is you don't necessarily have to know the theory. You have to know how to operate it.
Yeah. Okay. All right. Thanks, Kevin. Now, I want to move on to statistical process control. You've mentioned it a few times, and you've kind of give us a little bit of an insight on what it is. But can you talk a little bit more about exactly what it is and how it can be applied to trading strategies and potentially the failure of trading strategies?
Okay, so one way to think about this is uh, you can look at all your trades and you have all your individual trade results. Okay, and you can calculate the standard deviation of those results. So, for example, let's just say you had a trading system that always won $100. Okay, well that would be a straight line equity curve up, and the standard deviation was 0.
Mm.
So, uh, obviously, we don't have trading systems like that. We're going to have results, and we're also going to have a standard deviation. And the idea behind with the Monte Carlo and this probability cones, which I know you'll show in a little bit,
Yeah.
is that as your equity curve goes with time, there's actually levels where the equity curve should be, unless something is going wrong. So, meaning the equity curve should be going up and to the right. But if it starts going down too much and it violates some amount of standard deviation, it actually would be considered out of control. So, like in a manufacturing process environment, you'd be watching for drift of a machine, for example. So, let's just say you were making parts on a machine, and every part you made wore down a part of the machine, and you produced parts that kept trending down. At some point, the statistical process control would say, hey, you've got to do something to this machine. And
Mm.
so I just have taken the same basic concept and just applied it to an equity curve where, let's just say your equity curve is trending down. At some point, it's going to be what we call an abnormal condition. And you'd
Mm.
say, hey, you have to take some kind of action here. And unfortunately, with trading systems, usually the action is, hey, turn it off. It's not like you can really go and adjust things and get it back into control like you could with a manufacturing machine.
Yeah. Yeah. So, I can think of quite a few ways you could use that, though. There's a lot of metrics that you get in backtest reports that you can use to monitor your strategies. And I think I even saw in the chat someone asking about win rate and Sharpe ratio and things like that. Uh, Do you have any? Do you have any metrics you think are more valuable than others to look at if you want to use this type of technique to monitor your strategies?
Um, no, I mean, you could use a lot of different metrics.
Mm.
I like the equity curve because it's something that intuitively just makes a lot of sense to people, because every trade they get to plot their equity curve and see it how it should be going, because they know based on the back test what it should be doing, and then they get to see how it's actually doing. If you did like consecutive wins or consecutive losses, uh, that could be another one that you could use where, hey, if you had so many consecutive losses, now it's out of control because it's something different than you've ever seen before.
Yeah.
And then you've got other metrics that might not be as good. So, for example, drawdown. Um, I can't see that being that good because you could go down and then it will go back up, and you could say, well, how long do I have to endure a drawdown? Maybe the time of the drawdown, but the amount uh, might not be as good of a metric. So you could
Mm.
definitely use some other metrics, but I tend to like just using the equity curve and just building trade after trade with it.
Yep. Yep. We've got a good question here from BK. Let me just pop it up on the screen here. G'day, BK. Can you quantify this abnormal condition in terms of number of standard deviations?
Okay, so if you talk about standard deviation, normally if you're within plus or minus one standard deviation, the numbers are around 62%. So 62% of the time, if you had an equity curve and you drew these one standard deviation bands, you should be within plus or minus one standard deviation about 62% of the time. Two standard deviations would be 95% of the time, and three standard deviations would be 99% of the time. So let's say you put three standard deviation bands around an equity curve. If you went below three standard deviations, you have a very small chance of that happening just due to a random chance. It kind of means, hey, there's something wrong with your strategy because you're well out of bounds. Now, the problem with using three standard deviations, it's 99%, but from a dollar or, just a percentage or whatever, however you want to put the loss, that's going to be a pretty big figure. So a lot of people like to use two standard deviations, which is 95%. And then if the equity curve falls below that two standard deviation line, hey, they would conclude that's a good time to stop. Now you can be real conservative and just say one standard deviation. But you got to realize at that point, it could be falling out just due to random variability. So it's not necessarily meaning your strategy is broken at that point.
Yeah. All right, thanks, Kevin. Let's keep moving on because I know we're going to be talking about probability cones. Right now, actually. So how about a bit of basics first, or some background? What are probability cones?
Okay. If you want to show, if you could show the one
slides.
Curve, that first one. Let's see, keep going. The next one. There you go.
This one?
Okay. Yeah. So that's to the left. What you see in I believe it's black, is just that equity curve that we've been showing before. And then to the right, I've just put in a sample strategy, and that's in the blue with the dots. Okay. What you have is you have a mean line that's based on the backtest, which is that gray line, and that just kind of goes off. So if you're hitting that gray line, then you're about the average of where you expect that Monte Carlo to be. Okay. And then you see there's two green curves on top and two red curves on bottom. The inside red and green curve are plus or minus one standard deviation. I just want to look real quick, just to make sure. Yeah, it looks like one standard deviation.
Yeah.
So that's, as I just mentioned it from that last question, 68% of the time you'd expect to be between those two values. And so, that's a good indication of general strategy health. You're running live, and as long as you're between those two, hey, things are going good and life is good and you're okay. You can also use the two standard deviation curves, which are the upper green and the lower red. And as long as you're between those, chances are you're still okay. The interesting thing there is, take a look at that bottom red curve. You actually see in the beginning, it goes down before it starts to curve up. And so what's that's saying is, just due to the randomness of picking trades, you actually could be losing money, and it doesn't necessarily mean your strategy's broken. And as I said before, a lot of people like to quit after 10 trades or 2 weeks, and I'm not making money. Oh, I should be making money. Well, this tells you, even with this strategy, that you very well could be losing money. And it's just normal. It's nothing to be uh, concerned about, at least from a strategy standpoint. You might be concerned because you don't like losing money, which that's understandable, but just from a pure like math statistics point of view, you shouldn't be alarmed at that. And that
Mhm.
throws a lot of people off because uh, people like to think they're trading a system. It should be making money all the time. And it's hard for people to realize that, oh no, you could be losing money. So
Yeah.
with those probability cones, as long as you're within, say, that upper and lower cone, uh, you can pretty much assume that things are good and things are working right. Uh,
Mm.
and if they go down below, which I think I believe that's the next chart. So
Yep.
if you could show the next chart, I'll give you an example. So there, your strategy was doing good, and then all of a sudden it starts doing bad, and then it cuts below that. You might say, "Hey, it's time to turn this strategy off because it looks like it's failing."
Mm.
Uh, it's more than just a random possibility that this happened. This is probably something real that's happened in there. Now, obviously the bad part about that is from your peak equity, you've lost quite a bit of money before this says, "Hey, turn everything off." Um, but a
Yeah.
lot of times that's the way it's going to be with trading strategies. You don't know with any kind of certainty that the strategy's really broken as opposed to just
Yep.
bad luck. Um, and that's just one of those things you got to kind of accept with trading is from what I've seen, what most people do is they will turn off strategies before they're really known to be bad strategies because they
Yeah.
can't handle the losing, which I totally understand. I mean, I've done it too, where even though it might still be within that probability cone, you just freak out and you say, "Oh, this strategy is no good anymore." And usually, what happens is that's when the strategy starts to turn around. It's like the market's out to get you. I've
Yeah.
thought that a lot of times where I've been like, "Man, I quit at the wrong time."
Yep.
So, the nice thing about doing this, it's not a foolproof method, but at least when you do it, you you have some, uh, I guess, theoretical basis. It's an approach you can put on any trading system, and then it's more objective. So you're not just going uh, off emotion to say, "Oh, I don't like the strategy anymore,"
Mm.
or "I'm upset, scared about the presidential election, so I'm just going to turn this strategy off." You go with rules and discipline, and I think in the long run, that's what really pays off is just having objective rules and following them.
Yeah, yeah. The thing I like, I use these probability cones as well. The thing I like about it is it gives something some context. But if we go, let me just put the slide back up. If you start those cones, at the last peak, I imagine that this strategy equity curve would at some point go below the bottom red one and then turn around, which, as you mentioned, is a danger. But
Right.
I just want to put a question here from Brian, which kind of links to this. Do some strategies tend to mean revert from upper and lower cones?
Um, hmm, that's a good question. Not that I've really seen. I mean, most strategies when they're working, when you're going with real time results, tend to be within, I would say, below the +1 curve, that second green one,
Mm,
and below. It's hard for strategy. If strategies get much above it, I start to get scared that something. It's a good thing,
yep.
but still, it scares me that they are gonna do a mean reversion. If a strategy does too well for too long, I start to get scared that, hey, eventually it's going to come back to its long term, right?
Yeah.
That's kind of how you got to look at it. But a lot of strategies end up coming close to the mean line, but don't even get there. So a lot of strategies just hang on that lower uh, portion of the curve and just kind of stay there. And they might still keep going up. They're just not going up as well as the back test. So
Mm.
you do get some performance degradation, just, as I said before, because of the good luck and bad luck type thing.
Yeah, yeah. A question here from Ola. G'day, Ola. Could you please comment on using open or closed equity here?
Um, yeah, I would always include open equity. Now, I believe this particular chart just is on closed trades. That being said, you could also do it on daily results, which would be the open equity plus the closed equity. So, for example, let's just say you had a trading system that took 2 trades a year and you just stayed in it a long time. Well, you might not want to use closed equity because you'd only get 2 trades a year on this chart. Then you
Yeah.
might want to use daily or weekly data. So some of this depends on what you are trying to do and what kind of data you have. But in general, for most things, I like to use open equity if I'm looking, obviously, if I'm looking at daily or weekly results. But if I get, say, 30 to 50 trades a year, I might look at closed equity of just those closed trades too.
Yeah. We've got another question here from BK, which I think follows on from that point you were just making. Let me just put it on the screen here. Excuse me. Is the breakout of the cones more significant if the trading system is high volume? I assume he means a lot of trades, not position size, and therefore the breakout from the cones as a result of a larger number of trades.
Uh, is it more significant? That's a good question. Uh, I think it could be because you just have uh, the more trades you have. Obviously, I think the better the estimates are going to be of that future performance, just because you're going to have a better estimate of the average and standard deviation. But I mean, I still like the cones, even if you only have, say, 50 trades to 100 trades in your walk forward analysis. But yeah, in general, the more trades you'd have, the better off I think the analysis would be.
Yeah. Another question from Ola, actually. Which links into what my next question was going to be, is where do you actually start the cones? But Ola's question is, if you had used probability cones at the 50 trade mark, you would have stopped trading this strategy soon after, which is, I think, what we already touched upon. But I think there's a broader question here in where do you start the cones, and do you update them? Do you shift them every quarter? How do you actually apply the start point of the cones?
Um, that's a good question. What I do is I put the cones at the start of real time trading, and by that I mean right when I finish development, just to see how it goes. So typically, what I do after I develop a strategy, I watch it live for a while before I start trading it with real money.
Mm,
And so I'll just keep the cones there. Now you could update them. You could shift them along as you're going and say, hey, every year I'm going to move that cone. And that might actually protect you from some of the you know, drawdowns, because now, you can see how those cones get bigger and bigger. So if you don't update them, the curve could take a long time before it falls below that lower cone. The
mm,
drawback to doing that is, in the beginning, I tend to think those cones aren't as significant, or aren't as uh, good to use, because you could have a couple bad trades and all of a sudden you just drop below the cones at the beginning.
yeah.
Let's say you get 2 bad losers in a row and all of a sudden you think you have to stop trading the system. So you've got to kind of balance that out uh, when you actually do it in real life. But I like a lot of times just even leaving it where development ended and just letting it go from there and just seeing how it goes long term.
Mm, yeah. And what about if you're doing a regular re-optimization? Say you re-optimize your strategy every year. Would you shift the cones when you're using new values, or how do you manage that?
You could, yes, and especially if you were going to optimize, if you were going to update what your predicted results were as far as your back test. So let's say you every year you re-examine your strategy as if it was a new strategy, and
Mm,
then you're going to get new Monte Carlo results and everything. Then it probably makes more sense to actually start the cones over again.
yeah.
Uh, yeah, so some of that it depends on how you want to use your data because obviously the back test is going to be a little over optimistic, but then your real time trading, that's obviously as realistic as you can get, and so maybe you want to put more weight on that. So uh, yeah, that's a good point.
Yep. Yep. Another question here. This one's from Al. Let me just put it up here. G'day, Al. Would it make sense to move the cones backwards equal to the largest number of losing sequential trades seen in the walk forward test?
uh, Al always has good questions,
Yeah.
so uh, Al's a smart guy, so I happen to know him.
Yeah.
um, I've never tried that. That's an interesting thing to try. So I might actually go back and take a look at that. But move the cones backward. Uh, yeah, I mean, you actually, I see what he's thinking there. So I'll have to look at that. I've never looked at that. So that
So I
could be
think
something
yeah,
useful.
I think he's trying to say, um, uh, trying to include some of the worst performance periods in the cones, just to rather than outside, and yes, perhaps start on a
Right.
better period. So yeah. Um, Another question here from BK. I think we might have touched on this a little bit already. I assume that you will not stop trading if the breakout is on the upside of the cones.
Um, Not necessarily. Like I said, that scares me too.
Yeah.
When you get that, so you have a trading system and you've tested it for 10 years, let's say, and you have all this data. Now all of a sudden you're doing much better. Uh, that tells me most likely the market has changed.
Mm,
You know, or maybe you just have extremely good luck, but probably more than likely something fundamental has changed that your strategy didn't necessarily account for. And so there's two ways of thinking about that. Is one is, well, hey, it's just going to continue doing great for a long time. But I
yeah.
tend to think the opposite and think, well, what comes up must come down. And I tend to think it'll eventually go back to the long-term average,
Mm,
assuming that maybe the market hasn't changed. Maybe I just had good luck. Um, so in cases like that, I tend to play it more conservatively. Some people tend to say, "Hey, I'm on a hot streak, so therefore, I'm gonna bet even heavier. Increase my size." I tend to do the opposite because I get scared that, hey, it's doing too well, way better than I thought, and I better watch out because, you know, not knowing anything else, I would assume it would come back to that long-term
mm.
average, which means you're going to have a good losing streak soon.
Yeah, yeah. I want to post a comment here from Adam. He's when you were talking about that, he's like scares us, but also makes us happy, like a horror comedy. But
Yeah, exactly.
yeah,
Yeah, it's a good Halloween thing to think. Hey, it's so your performance is so good, it's going to continue forever, but it never does,
no,
and I
I'm
wish it did.
yeah, I'm actually having that exact scenario now with a gold future strategy I trade, in that it's had Probably the last year has been its best performing year by a long way. And when you map it into these cones, it's, traveling along the top one. And, I
Right.
know it's not going to go forever, but it comes up to the point, well, where do you stop it? Should you stop it? Should you let it run? If I'd stopped it 6 months ago, in hindsight, well, yeah, it's made more money, but, is it going to fail tomorrow? Maybe it's going to be miserable. So, I mean, if you look at the gold
Right.
market, it's had a pretty good run the last year or so. So it probably goes back a little bit to the point where you say, markets are changing fundamentally. But that's a good thing to consider. I think it comes back to the point you made very early on: is you need to come up with a plan beforehand and then execute it, rather than flying by the seat of your pants and thinking, well, what am I going to do now? So
Yeah, exactly.
yeah. Okay, so we've talked about a lot of advantages and benefits of using these probability cones. What about some disadvantages, or are there any dangers with using them?
Yeah, I mean, the biggest one is you're basing this all off of your back test.
Mm,
So again, I'll go back to, if your back test is flawed in some way, um, it using it that data going forward is going to give you some bad results, or it's going to lead to bad assumptions on your part. And
mm,
that's probably the biggest thing. And the second one is just putting too much faith in it. uh, go back to the whole manufacturing type analogy. It's That's a little more predictable with machines, and after a while you can get good data. But with trading systems, it's you don't necessarily know a lot of this stuff.
mm.
And yeah, the system could be broken. It could be your back test was just showing a little bit better than what you get in real life. uh, so with any of these things, uh, you have to use some caution. I know it sounds kind of hard for people who might just be new to this to say, well, what do you mean? You're telling me to use this, and now you're telling me, well, watch out if you use it. It's not foolproof. There is no theoretical. Like I always tell people, this isn't rocket science where there's a set of equations to get to the moon, and you just have to follow those, and you'll get to the moon. There's a lot of uncertainty in trading because there is no theoretical type yes or no, this is the one way to do it. And so people have to be aware of that.
Yeah. And what about applying these probability cones to other aspects of trading? For example, at the portfolio level, have you looked into doing that, or do you do that?
Yeah, I mean, I do. uh, the drawback to that is, from what I've seen, if you have, let's say, 10 different strategies, you'll have 10 different back tests.
Mm,
um, and of course all those back tests are good. They won't necessarily, you're not going to get that good of performance going forward that you have from adding up all those 10 back tests. That just doesn't happen. And that might be a lot of uh, just seeing good luck disappear even on a couple strategies. So like I said, chances are in a back test you have some good luck built in. Well, now you're saying, hey, I have 10 systems, they all have good luck built in, and I'm going to assume good luck continues for all 10 of them for a portfolio. And that's more than likely not going to happen. My experience with trading portfolios is, let's just say you had 10 good systems in any given year, maybe two or three will perform really well. Uh, Four or five will probably be around break even, maybe make a little money, not do bad or good. And then you'll probably have one or two at least that will do bad, a lot worse than you thought they were going to do. And
yeah.
so using this with a whole portfolio, um, from what I've seen, tends to give even more overly optimistic results. And so you definitely have to watch out for it
Mm.
more so with that.
Okay, sure. So, if traders want to investigate probability cones more, how do you recommend that they get started there?
Well, like I said, you can visit my website, and if you go to the resources page, I have a whole huge article on this topic,
Yeah.
and you can also download a calculator to get into it. Um, if you want to learn more about the theory of just Monte Carlo and that type thing, uh, I know there's some good books out there. None come to mind as far as like just for trading, but there are a lot of guides out there and books of people who've done Monte Carlo in general. And,
Mm,
that could be something else you want to look at too.
yeah. Okay. All right. Thanks, Kevin. We got quite a few questions here in the chat, so I might just run through some now before we finish up. So,
Okay.
actually, here's a funny comment from Adam. What about if an old trader needs to be retired?
Yeah, that's if your equity curve keeps going down. That'll just tell
Yeah.
you
Yeah.
time to split
Exactly.
up.
Another question here from HC. Kevin said stop trading when the highest drawdown comes. What about after 3 losers in a row in 1 hour on 2-minute time frame? Stop trading for 1 hour?
Well, a lot of that would depend on what your historical testing has said.
Mm,
And let's just say you've never had more than one loser in an hour on your 2-minute time frame. Now all of a sudden you hit 3. Yeah, then that might be a good thing to do to stop trading. I don't even know if 1 hour is the appropriate thing. Uh, but certainly that would kind of could be a good warning. But let's say your back test shows that you could easily have 4 or 5 losers in a row. Then this might not make sense because there's a chance, just random chance, you would have had that many losers. So
yeah.
you got to kind of look at what you historically your system has done and you know kind of go from there.
Yeah. Okay. Here's another question from Ola. This one was put in the chat before we got to probability cones, so you may have answered it a little bit. But if you use some measure to decide to turn a strategy off, would you use the same measure again to turn it back on, or would you adjust the strategy to the new market conditions?
um, yeah, that's a good point. You could use it where that curve I showed earlier where it went out. You could wait till it came back up into the cone and then start trading it,
Mm,
because theoretically now it's kind of it's back in where it should be at least. uh, but from a practical perspective, that is really hard to do. So think about if you were trading the system live. Now you've traded it live and watched it go down and it comes out of your probability cone, and you stop trading, but you've lost a lot of money. Now it comes back up and goes back into the cone. um, you're going to be hesitant to start trading it with real money again, because now you're right at the bottom. And if wonder if that next trade, for example, is bad, now you'll be off again. You'll say, oh man, I let it go up and then I trade it and it goes back down. And um, so from a practical point of view, it's psychologically, it's really hard to do that. What I would like to see with a strategy that's come down below it is to go up and come close back to the long-term median line, or that gray, the straight line in the middle.
yeah.
So it's got to have some good outperformance. And if it came back close to that, then I could say, okay, well, now it seems to be back performing normally. Now I might start trading again. The bad part about that is you've just lost, there's that opportunity cost of losing
Mm,
that upswing, because you weren't trading it because you were still wondering if the strategy was good. So it went up back up to the long-term mean, but you weren't along for the ride.
mm,
So again, that becomes a practical thing. And what it comes down to, at least for me, is usually when I determine it's broken or something's going on, I usually just turn it off and keep it off.
Mm.
I might still monitor it, but uh, the old saying, "Once bitten, twice shy," rings true for me. I mean, yeah, hey, this strategy cost me money already. I
Yeah.
don't necessarily want to jump into trading it again until it's really doing pretty good. So hopefully that answers that question.
Yeah. A question here from, I can't even read this name, Isla something. Do you pay attention to Sharp ratio, K ratio, or RENA in the TradeStation strategy performance report?
No, no, no.
There you go.
That's the short answer. And it's not to say that Sharp ratio isn't good. It's not to say that arena's good, not good, or K ratio. I just don't use them.
Yeah.
Eh, from my perspective, using the Monte Carlo and doing things the way I do tends to work well, and a lot of this stuff correlates. So it's not necessarily the case where one of those numbers will be bad and the other ones will be good. Usually things are good altogether. So for example, a lot of people say, "Hey, don't use just net profit." Well, that's true,
Mhm.
but net profit for a lot of uh, trading systems also correlates fairly decently with drawdown. It's hard to have a good net profit at the end of a back test and a huge drawdown. That does happen, but normally those two kind of go hand in hand. The better systems have less drawdown. So,
Mhm.
um, I wouldn't get too, I guess my point here is don't get too hung up on metrics because a lot of them tend to kind of all go in the same direction. But if there's one you really feel comfortable with, you know, uh, definitely use it.
Yeah, sure. Okay, we've got 2 or 3 more questions here. Kevin, can you spare a few more minutes? Because I know we're out of time now. So,
Um,
you
yeah,
good?
sure.
A couple more minutes? Okay, thank you. So, here's one from Al. Here we go. Let me just pop this one up on the screen. It's kind of small, isn't it? What about reoptimizing parameters when the strategy machine appears to be breaking down? Is that cheating if the time frame of your reoptimizations in the walk forward run is different?
Good question. And I've done a little bit of work with that and really haven't come to any conclusions that says, hey, definitely do this or don't definitely do it. So
Mm,
normally with walk forward, let's just say you re-optimize every 6 months. So, that's the way you ran your back test and that's the way you're going to go forward. And so you're consistent. So what Al's saying here is, hey, instead of every 6 months, maybe sometimes it's 2 months and then it's 4 months and 8 months.
yeah.
It depends on when your strategy goes bad. The way you'd have to analyze that is to use a walk forward analysis that was uh, based on performance. So your window, your out, your reoptimization window was based on performance. And I just thinking off the top of my head, uh, there's no software I know that does that easily. Maybe there's some out there, but that would be something you'd want to test and evaluate and see because it might be something good to do. Um, but again, what you'd want to do is test that over, I don't know, 50, 100 systems and see, did it really make a difference? It may, it may not, but it's something that'd be worth investigating. I think just the setup of it would be a little bit difficult.
Mm, okay. Here's a question from Hussein. Welcome, Hussein. Um, how about long run high linear regression correlation in equity curves? Suppose with 100 trades in 10 years by 2 parameters. Long run
Um,
high linear regression
not
correlation.
Okay. I'm not really sure what he's uh, asking. Maybe you can get some clarification as far
Yeah.
as doing that instead of what. That's where I'm having trouble.
Yeah. Okay. All right, Hussein, if you want to put some more detail in the chat, we can come back to that one in a sec. Here's an easy one. Here we go. This is a dead easy one.
I
It
like
comes up
those.
quite a lot. This one's from Phil. G'day, Phil. What version of TradeStation do you use for automation and why?
I use so TradeStation's right now at version 10, and it's actually been out I think a couple of years now. I just recently upgraded to version 9.5, so I'm they don't even update that version anymore. I was at 9.1, and for my live trading, I'm all about trying to get the most stable version out there. So I don't want crashes and that type of thing. And with TradeStation, probably with any software, when those new versions first come out, there's always more tendency to have crashes. So um, yeah, Windows, for example. So I know they just updated Windows 10, and a lot of people were having crashing issues. Okay,
Yeah.
well, I don't have to worry about that because I'm still running a computer with Windows 7 on it. I'm like way back. But again, I favor stability more over the latest and greatest. So
Mm,
for my live trading, I use 9.5. I'm running a laptop right next to my live trading, and I am running TradeStation 10 on that, and I should say I'm doing that in just development, so no live trading, but it's for me, it's really stable. Also, I don't get crashes. So usually, the people who are getting crashes uh, are probably doing something. I don't want to say wrong. I don't even want to say abnormal, but they're doing something out of the ordinary. And really, what if you're getting a lot of crashes, whatever version of TradeStation you're using, what you really have to do is try to narrow it down to what is really triggering that. And it might be, hey, I'm running 20 tick charts all the time.
yeah.
And well, hey, maybe you only want to run 15 of them and then you won't get that problem. I don't know. But hopefully that kind of addresses that issue.
Yeah. Okay, we've got a little bit more detail here from Hussein. Hussein saying a smoother or a more smooth equity curve correlation 99% smoothest, like a straight line. I'd love to have a
Okay.
strategy like that.
Yeah, so would I. And in relation to,
sorry.
is that necessarily a better test, or is that a better back test? A lot of times, what I've seen is those smoother curves, those ones that are almost straight lines. A lot of times, the fear I have, and it's been borne out by like real time results, is those tend to be a little too curve fitted or a little too over optimized. So you got to kind of watch out for too good and unbelievable. So for example, one of the research projects I'm doing now is running basically like millions of back tests. And what I'm seeing is if your back test is too good, uh, instead of it being a good predictor of future performance, it actually works the opposite. It becomes a predictor of bad performance, which kind of goes against a lot what people are thinking. But I think what the issue is you're just a little too overfit. And hey, being overfit to a back test is nice. Almost never. You know what I mean? It's people think having a great back test is the ultimate key, and that's not true. It's you can have a pretty so looking back test, but if it performs well live, that's what really matters. So hopefully that kind of addressed his question.
Yeah, yeah. Okay, thanks, Kevin. Well, I'm conscious of the time. We've got a little bit over, so I just want to start wrapping up now. So how can people learn more from you? Where can they go?
You can just go to my website, kjtradingsystems.com. You can also sign up on my website for my email list. I put out articles that are similar to this one. So, for example, next Sunday, I'm starting a 5-part series on what's the best exit, where I'm going to test 15 different exits over the course of a couple weeks so people can get that research for free. I also run a workshop. The next one's actually coming up in 4 days. There's still a couple spots open for that, but it's a strategy. It's called the Strategy Factory Workshop. It's how people can develop strategies using all the techniques that I use that help prevent overfitting, over optimization, and it keeps you away from a lot of the mistakes that people make when they develop trading strategies. So, my website's perfect for it. You can also search for me on YouTube. I've got, I don't know how many videos now, ton of different videos, some short, some long, all different kinds of trading topics.
Yeah.
I think people will find some use out of that.
Yeah, absolutely. Well, thank you very much, Kevin. It's always great to talk about trading with you. And I'm just going to post up a little bit of feedback in the chat. So Tim said, thank you. This interview has been great. It's a pleasure, Tim.
Thanks, Tim.
Here's one from Ola. Many thanks, Kevin and Andrew. And
great.
I won't go through the chat now, but thanks again, Kevin. So please, if you enjoyed this interview with Kevin, don't forget to hit like on the video and perhaps leave a comment if you want to share your number one insight from what Kevin has shared today. He's dropped a lot of gold nuggets, you could say, I guess, in trading insights. So share, let us know which one you like the best. And just for next week here, in my notes, we're going to have Perry Kaufman. Perry is coming along to talk about how to survive market sell-offs. We're going to be talking about price shocks, what they are, how to detect them, and how to protect your account so you don't blow up your trading when we have price shocks. So kind of a little bit along the lines of what we've been talking about today, how to protect your account and make sure you don't blow up. So that'll be same time next week, 7 p.m. Central on Sunday, and then obviously Monday morning in Australia for all the Australian listeners. So thanks again, Kevin. We've got some more thanks here. Al said thank you. And so thanks again, and I wish you all the best.
All right. Well, hey, thanks, Andrew. Thanks for having me on. This is you have a great show, a lot of guests I love to listen to. So you're doing a really great thing here and a great service for all traders.
Yep. And don't sell yourself short, Kevin. You got a lot of great content on your website and on your YouTube channel as well. So thank you. And thank you for being so open with all your knowledge. It's really helping the trading community. So we're getting a lot of thanks come through. I can't even keep up with them. So thanks everyone for joining us today. Thanks again, Kevin. And have a great week next week. Cheers.
All right. You too, Andrew. Thanks.
Okay.
See you, everybody.